Hello and welcome. I'm Jason from smarthelping.com. We've got a nice kiosk model update, fully revised. Basically, I built the revenue from scratch, redid the whole revenue based on a capacity style model. We added a three statement modeling, so financial statement, income statement, balance sheet, cash flow statement, added a cap table. So tons of value added to this template. If you want to look at what a robotic kiosk is, it'd be a sort of vending machine type stand. Looks like one person run operation, but requires no staff. That just has to be refilled once a day. Outside of that, everything is fully automated. People pay money and use the kiosk or output whatever smoothie, food, beverage you are selling. Only just sells in this shade. So that's the model. That's the business we're going to model, and I'll go through and tell you what each tab does, explain the assumptions, and then you'll understand how to use it. This is a $45 one-time fee valued template, and it is part of the industry-specific template bundle as well. So if we go here, start with the company name. You can name it whatever you want. We could go Kiosk 123, and that'll update on the financial statements accordingly. Launch year, make sure when you change this, if you do change it, you update all relevant drop downs, which will be on these yellow tabs. For example, if I change it to 2023, now the time period goes out, an extra 12 months from where it was. Put this back. The model is a 3-year model, monthly and annual. It's for figuring out startup costs, operating economics, and potentially exit value. And exit value is just there for proper discounted cash flow analysis. And you can see here you can choose to include a terminal value or not. If you hit no, then it won't show up. If you hit yes, it's going to take the trailing 12-month EBITDA and multiply it by this multiple to get an exit value. We also have some funding sources here, so you could fund some with a traditional P&I loan, and that'll go throughout the model accordingly, or you could zero that out if that's not what you're doing. And then any remaining equity required, which is what the whole model solves for, based on all the operations and startup costs and net burn. This is saying the minimum amount of equity needed so the cash balance doesn't go below zero. And you can see here, balance sheet monthly, we always solve for zero. It never goes below zero. Okay, and then any remaining funds, so the 711,000 will come from investors, and it could be insiders or outsiders. You will define all of these assumptions on the cap table tab, and it'll flow to here. So if you look at the cap table, you can define total shares, up to 3 share types, the amount invested by each outside investor, the percentage of each stock type or share type that they get, their fully diluted ownership value populates here. Also, same thing for any owners, operators. This note row 30 to filler calc. So any remaining equity that wasn't put up here or here will fill in here. You've got some checks down here. These should always all be zero, or else you've assigned more equity than you have, or invested or got investments more than you need, or something where the numbers are not logical. So you've got checks. You've also got a discounted or a IRR calc for each individual based on the available distributions and contributions over time, and that aggregates as well. And then finally, we've got taxes. So you might not be accounting for taxes in this model, which is fine. You can zero it out. If you do, you can put the tax rates here, and that will flow. You'll see that logic happening on the income statement at the bottom under taxes here. And it does separate between if you do sell, you can have the sales proceeds, some of it go to fixed assets versus extraordinary income, and then taxes will be applied accordingly. And on the terminal value, you can define what percentage of the exit proceeds go to each of those. And then based on the capex table here, you'll see any net gains or losses based on the book value at the sale month. I'll get into this in a little bit more detail after we get through these other tabs. And then finally on the global control, you've got sanity checks. This is to make sure all the income statement, balance sheet, cash flow statements, all the numbers there match up with your monthly and annual detail, as well as your distributions tab. and these should always be 0 no matter what. Okay, so deployment schedule. This is really cool logic. Brand new revenue logic. I've never done something quite like this, so there's probably a lot of uses for it. Basically, you can plan out up to 5 expansions of these kiosks. So expansion 1, you can do the start month, the amount you're expanding, or how many you're adding, the cost per unit, total cost. And then here's where it gets interesting. You could define up to 3 items that you're selling out of the kiosk. And if you have more than that, you can do averages, like category averages. So for each expansion, you can do different pricing. If you have different locations, or it's a little bit of a different product mix, so you can adjust the pricing on each of those, the count that you're doing with each of them, the start months, the cost per unit, and then max units sold per day. So this is saying you can adjust, maybe you think the max units sold, you could have different kiosk types too. So these could be low end or high end or larger or bigger. It just allows you maximum granularity. So this is the maximum per day that a given kiosk could ever sell. Then you do starting capacity. So now you can go by the type of, type 1, 2, and 3 products that you're selling. And then based on the max, how much you think you're going to start selling right off the bat of this max per day. And that can be dynamic for each of these expansion uh, slots as well. And then how much does that improve per month? So this is improvement in capacity attained. And then what's the maximum stabilized capacity? So this is what you think in the long run what you'll do. And it could be 100%, 90%, 80%, whatever the case is. And then what's even more interesting is we've got these visuals here to help you see what you're actually saying when you have these capacity numbers in here, improvement numbers. So you can see this is a starting capacity of 10, and then it goes up by 2% each month until you stabilize. And then here you can see, look, I'm doing 67 unit sales per day per kiosk. And this 67 is a total of all of these, type 1, 2, and 3 together. So the total of all those sales will equal 67, and that would be 70% of the maximum. And it shows that for each of the different expansions, since you can have different timings here. So that's really interesting. You've also got unit sales per day for each expansion. So this is unit sales per kiosk per day. This is unit sales per day across all kiosks. So across 10 kiosks here, you would see now you're starting at 95 and going up. And these are, they'll stabilize depending on how fast your growth rate is, the timing of when it started, and all of that in your maximum stabilized capacity. So the last chart then shows, the last chart is basically a summary of all of the top part and this part all combined into one. So you've got average sales per day per kiosk across, but this is the average of all of the kiosks. So this is basically taking the average of all this and putting it together in one line. And then you've got total units sold per day. And that's going to be across all kiosks, across all expansions. So here, when you see you're getting to 3,790, that's across everything. How many total units you're selling per day among all of this. So if you were to get to 100%, you should be able to do, 475 times per day times however many kiosks you have would be the number. And that'd be the absolute maximum that you can do. And here we're only at 70% of that. And then the amount per day per kiosk is here, which is just taking the total amount divided by the number of kiosks. So really, really interesting revenue logic, and I think the visuals make it even more usable. Matrix tab has all of that dynamic logic working for each of the cohorts and the types. So this is where we're actually figuring out all of our data, figuring out revenues, and then here's the chart data. Running costs, pretty simple. There's variable and fixed. So for variable, we have a ratio that defines the amount of labor count required per one kiosk. So for example, if I put 0.33 here, it means one laborer is required for every 3 kiosks that are existing, and then this is their monthly cost per person. So that's variable. It's going to depend on how many kiosks you have over time. You've also got average repair and maintenance per unit, so $100 per month per unit, and you could change that in each of the years, as well as electricity cost per unit, and you could change that in each of the years. If you have other costs here, you can change the titles and group them together and figure out, whatever makes sense for your total cost per month per kiosk. You've also got fixed costs here. These are just operations. It could be legal fees, advertising, different things. So you can define the monthly amount in each year. I've put in some high numbers here, just they're arbitrary. All the numbers are arbitrary. You're going to put in what's relevant to you in your environment and market and everything else. And you can adjust the start month of each fixed cost. Startup costs pretty simple, just a regular schedule of costs, one-time costs that happen at the beginning of the template forecast period. And these would be the things like initial R&D, design, web design, maybe a reserve, and there's some extra slots here. You want to make sure nothing here is double counted if it exists somewhere else in the template. Like the deployment schedule is going to define your initial startup costs of buying the kiosks. So that's already in there, so don't double count anything. Debt schedule, this is just if you're going to do debt, you could define the terms here. The amount's going to come from the global control, and it's just a regular amortization. And at the end month, if you do choose to include terminal value, the end month will have all the debt repaid. If not, it'll just run like a regular schedule through to the end. So capex, row 1 is always for a building. That's probably not going to be relevant, so you could most likely zero this out if it's not relevant. Expansion 1 through 5 represent the kiosk build out, which is just automatically pulled from the deployment schedule. And then you've also got some extra slots here if you have other fixed assets that you think are part of the business that need to be depreciated. Cap table, we already went over this. Terminal value, we went over this. Income statement, so here you can see we did revenue for each unit type that can be sold out of the different kiosks. So the revenue per month, month over month change, the cost of goods sold, which is going to be mainly your ingredients, gross profit, fixed and variable expenses, startup costs, total operating expenses, EBITDA, interest, depreciation, and then we've got taxable income, income tax, capital gains tax, and then net income. And this will flow over to the balance sheet in retained earnings is where this goes. So income statement annual is the same thing, but on an annual basis. There's some checks here to make sure that they equal each other. Balance sheet, we've just got cash. We've got the non-current assets, which is going to be your expansion of the different kiosks, and then anything else you have in there. Accumulated depreciation, then you've got your total asset value over time. Got any long-term liabilities is only going to be the debt. Then the common stock is any investments. Retained earnings is coming from the income statement, like I said, and then you've got total owner's equity. And remember, assets always equal liabilities plus owner's equity, so these have to balance, and they do. In the end, here they also do, even in the last month, we have to zero out debt, accumulated depreciation, fixed assets, and then that cash is going into here. So these are all interconnected. Balance sheet, same thing, but on an annual basis. Cash flow statement kind of gives you a really good idea of what all is affecting cash in the right timing of it. So here you've got operating activities, investing activities, and then financing activities. And then the total is going to be the net change in cash, which is actually going to represent this cash. This is how we're calculating the cash balance on the balance sheet. So you can see all this is connected and it has to be accurate or else it would not balance. Cash flow statement annual, same thing but on an annual basis. Executive summary is kind of cool, a little bit different here than normal, but I like the style so I kept it. Just shows, you've got revenue here, gross profit, EBITDA, debt service coverage ratio, expansion cost, cash flow before tax and other capex. So this is kind of just your operating activity, cash flow. Then I did revenue per product type, reaches a 3, you've also got average revenue per unit per year and average EBITDA per unit per year. And then we've got break-even summaries here. This is the break-even revenue, and then by quarter, per month, and per day, the amount of break-even required. And then all this is expressed visually in these nice charts here. Any cash position, any debt balance, cash requirement, internal rate of return, months active, break-even month. So this is the break-even month for equity. You can see it'd be right here. Visuals, we got some more here. Cost of goods sold summary, so all your different ingredient types, and then that's for each year. Average annual EBITDA, revenue, average annual. Hold on, did we change this? Oh, average annual revenue and EBITDA. Put a slash there. So we can see all this, the total unit count at the end of each year, and then how much each kiosk is actually producing in revenue and profits each year. Gross profit and EBITDA margins, expense summaries. I just did fixed costs, labor and other variable, and then ingredient material costs. So it's a good summary, total unit count. Distributions, here's your discounted cash flow analysis of the whole project. So you've got the IRR here based on a discounted cash flow, or based on a discount rate, you've got the present value of these future cash flows. And then we've got the same thing for the investor and owner. And these will match, so these IRR 70.5, 386 will match what's on the cap table for the total 70.5, 386. And everything is dynamic and adjusts with your configurations of the assumption tabs. So here's owner cash flow, net present value, investor net present value, and then you got the project. Monthly detail gives you a nice view of the granularity of revenues, expenses, fixed and variable, EBITDA, monthly cash flow per month, and then annual is the same thing, but on the same as a monthly but annual basis. So pretty cool stuff here. I feel like the template got a lot better. Really good summaries, just a lot of good logic in here in general. So enjoy, and I'll see you guys on the next one. Don't forget to